Most people spend 40 years working hard and still retire with almost nothing. Not because they didn't earn enough, but because nobody ever taught them the rules. In the next few minutes, I'm going to cover everything that actually matters about your money: budgeting, debt, investing, and building real wealth, so you can stop guessing and start making better decisions today. No fluff, no filler. Let's get into it. Let's start with the foundation. Where does your money go? Most people have no idea, and that's the problem. The simplest system that actually works is the 50-30-20 rule. 50% of your income goes to needs like rent, food, utilities, and transportation. 30% goes to wants like dining out, subscriptions, and entertainment. 20% goes to savings and debt paydown. Now here's the hard truth. Most Americans spend closer to 70% on needs alone. That means no savings, no investment, and no buffer. If your needs are eating more than 50% of your income, that's your first problem to fix, either by cutting costs or by finding ways to increase your income. And cutting costs doesn't have to mean suffering. Start with the low-hanging fruit. Subscriptions you forgot you signed up for, memberships you rarely use, or premium versions of apps where the free tier is good enough. The average American household wastes over $300 a month on subscriptions alone, and most of them barely notice. On the income side, think about what skills you already have that someone else would pay for: freelancing, consulting, tutoring, even selling unused items online. You don't need a second job. You need a second source of income, even temporarily, to break the cycle. One practical step you can take today is to write down every single expense from last month and put each one in a category. You'll probably surprise yourself. Next, let's talk about credit and debt. Two things that can either work for you or destroy you. Your credit score is a number between 300 and 850. It determines whether you can rent an apartment, get a car loan, or qualify for a mortgage, and at what interest rate. The biggest factors are payment history, credit utilization, length of credit history, and new credit inquiries. Pay on time, every time. Keep your balances below 30% of your credit limit, and avoid closing old accounts unnecessarily. Let me give you a real example of why this matters. The difference between a 620 credit score and a 760 credit score on a 30-year mortgage can mean paying over $100,000 more in interest over the life of the loan. Same house, same bank, just a different number on your credit report. If you're building credit from scratch or recovering from past mistakes, start with a secured credit card. Put one small recurring charge on it, set it to autopay in full every month, and never touch it otherwise. That single habit, done consistently over 12 to 24 months, can move your score significantly. When it comes to debt, not all debt is created equal. High-interest debt, especially credit cards charging 20%, 25%, or even 30%, is financial quicksand. Every month you carry a balance. You're paying interest on interest. The rule is simple. Pay off high-interest debt before investing in anything else. There is no investment that consistently beats a guaranteed 25% return. Paying off a 25% credit card is your best investment right now. There are two popular methods for paying down debt. The avalanche method, where you attack the highest interest rate first, saves you the most money mathematically. The snowball method, where you pay off the smallest balance first, gives you faster psychological wins and keeps you motivated. Neither one is wrong. The best strategy is the one you'll actually stick to. Before we talk about investing, there's something most people skip and later regret: the emergency fund. This is 3 to 6 months of living expenses sitting in a high-yield savings account. Liquid, accessible, and untouched. Without it, one unexpected event, a job loss, a medical bill, or a car breakdown, can force you into debt or make you sell investments at exactly the wrong time. Here's why the type of account matters. A regular savings account at a big bank might pay you 0.01% in interest. A high-yield savings account right now can pay 4% to 5% annually. On a $10,000 emergency fund, that's the difference between earning $1 a year and earning $400 to $500 a year just for having your money in the right place. Look for accounts at online banks or credit unions. They have lower overhead costs and pass the savings to you in the form of higher interest rates. The money is still insured, still accessible within a day or two, and still completely safe. If 3 to 6 months feels overwhelming, start with 1 month. Then build from there. Even $1,000 in a dedicated emergency account changes how you respond to life's surprises. Build this first, then invest. By the way, if you're enjoying this video and finding it useful, please subscribe to our channel. Now let's move on to investing, because this is where wealth is actually built. And I want to make one thing clear. You do not need to be rich to start investing. The most powerful force in personal finance is compound interest. If you invest just $200 a month starting at age 30 and earn an average annual return of 7%, by age 60 you'll have over $240,000. Start at age 40 with the same amount and the same return, and you'll end up with around $100,000. Same money, same discipline, but 10 fewer years. Time matters more than most people realize. If your employer offers a retirement plan with matching contributions, contribute enough to get the full match. That's essentially free money and an instant return on your investment. Consider opening tax-advantaged retirement accounts where your money can grow more efficiently over time. Once you've taken advantage of those opportunities, open a brokerage account and invest in low-cost index funds. Let me explain why index funds are so powerful. When you buy a broad market index fund, you're buying a small piece of hundreds of major companies at once. If one company struggles, it has very little impact on your overall investment. If the economy grows over time, your investment grows with it. Fees also matter enormously. Even a small difference in annual fees can cost you tens or even hundreds of thousands of dollars over several decades. Low fees aren't a minor detail. They're one of the highest impact decisions you can make. Don't try to pick individual stocks or time the market. Consistency beats brilliance every single time. Automate your contributions and let time do the heavy lifting. The worst thing most investors do is check their portfolio every day and make emotional decisions based on short-term noise. Now let's talk about protection. You can do everything right. Budget well, save consistently, and invest wisely, but one catastrophic event can wipe it all out. That's why insurance matters. Health insurance is essential because a single hospitalization can create enormous financial strain. If you have dependents, life insurance is critical because it protects the people who rely on your income. Disability insurance is often overlooked even though you're statistically more likely to become disabled during your working years than to die. A healthy adult can often get significant coverage at a relatively low monthly cost, making it one of the most cost-effective forms of financial protection available. Many employers also offer disability coverage as part of their benefits package, sometimes at little or no cost. Make sure you understand the coverage available through your employer or private providers. Finally, I want to end with something no spreadsheet will teach you. Your biggest financial enemy isn't the economy, inflation, or even your income. It's the decision to start tomorrow instead of today. Every year you wait to invest is a year of compound growth you'll never get back. Every month you carry high-interest debt. You're paying for a decision you made in the past. The people who build wealth aren't necessarily smarter or luckier. They simply start and keep going. You don't need a perfect financial situation to begin. You need a decision. So let's recap what we covered today. Budgeting, credit management, debt elimination, emergency funds, investing, financial protection, and the mindset required to build long-term wealth. If you want me to go deeper into any of these topics, let me know in the comments. And if you're enjoying this content and want more practical financial education, please subscribe to our channel. Thanks for watching, and I'll see you in the next video.